The results are in for this week's Trader Sentiment Survey report, and let's just say they're pretty mind-blowing. But with $5 trillion at stake in triple witching, what else do we need to know coming into this Friday? And what sectors should we really be focused on as the equal weight starts pumping up? We know that the Dow is making all-time highs and the Nasdaq and S&P 500 are not so far behind it. But with these things going parabolic, it's pretty hard to get involved in them unless you're just buying every single rip. So are there other sectors that need to be focused on? And more importantly, do we need to be looking at this chart? Yes, the hottest stocks and the biggest of 2023 are now the laggards. The Magnificent Seven is failing to make new highs. So should we be really looking at this chart a little bit more closely moving forward? Well, welcome back, everyone. My name's Tom. Today, we're talking about everything to do with markets, and we've been running this show for over 3+ years with daily content. So if you're interested in anything to do with markets, remember to subscribe and smash that like button. Much appreciated. It always helps. So let's get into everything that happened over the last 24 hours. First up, semiconductors did well, and energy came back with a big boom, including some laggards, which we've been talking about on this channel in previous sessions. The Mag 7, though, that did not fare so well. Microsoft, one of my favorite stocks, down 2.25%. And you can see here in the rotation, it was a pretty big switch. Solar, clean energy, and home builders and construction were really hot. And of course, everyone's now talking about regional banks breaking out in a big way. So could this still be part of a huge rotation that leads us to more parabolic trends? We'll talk about that when we get onto the charts, but you can see here the last 5 days have now been solidly overtaken by some of the worst sector rotations that we've had over the last year. Yes, the most hated stocks are now the most loved, according to the market over the last couple of days. Just a reminder as well, we have a new weekly newsletter coming out this weekend, so make sure to subscribe to that if you want to. It's totally free in the links in the description down below. So let's talk sentiment survey. I said these results would blow your mind. Let's talk stats here. What do retail traders think generally over the next 6 months? 51.3% responded as they were bullish, the highest reading since July of this year. We all know what happened a few weeks after that. We also had another massive reading, and this one's huge. The lowest bearish reading in 6 years. Yes, you heard that right. In 6 years, the lowest bearish reading. And when you take a look at options and also the cost of options, it will make some sense. But let's talk about some of the readings going on right now and why you can't pay too much attention necessarily to things such as this one here. The S&P 500 breadth percentage of stocks with RSI above 70, no doubt it's insane. 48% of stocks are now above 70 in one of the most overbought markets in over a decade. But does that mean it has to stop right now? Well, let's look at some of the evidence. First up, where are we going this OPEX? Well, we still have that 4,700 pin that we discussed. Obviously, there are 4,800 pins as well. But really, the 4,700 pin seems to be the biggest gravitation for this week's trillion-dollar expiration. It's kind of where we find ourselves at the time of this recording as well for the market. So it may want to just gravitate here, and then next week we'll find out whether it's willing to push a little bit higher. Because it's hard to stop a freight train. We'll talk about that later on. Retail is also pumping it up in terms of the amount of options traded. And you can see that by this time, the data is probably updated here. We're getting close to all-time highs over the last couple of years. So that's going to be a big deal. And of course, something we need to be paying attention to. So I mentioned before that parabolic advances usually go further than you think, but they do not correct by going sideways. This usually means that because we've now entered into a parabolic trend as of Tuesday and Wednesday, which really was, of course, the FOMC speech from Jerome Powell and how wild the market went after that, we're entered into the twilight zone. So these markets can pump a fair bit, but when they come off, they will be fairly brutal. So do expect the VIX to be spiking at some point over the next weeks into months when eventually this trend does break. In terms of performance, I thought I'd just bring this in anyway because we've been talking about it. Obviously, these are the stats. The stats are not necessarily working out at the start of this December. The pullback happened early, but it wasn't that much of a pullback. And now we've been ripping thanks to all of these interest rates. But there's what happens generally over OPEX in terms of plus, minus, and all of the days around it. We also know that revisions earning will be something that you want to look at in 2024. And I will keep bringing this up because really, Wall Street will eventually work out what's going on with earnings. And if earnings don't meet the criteria of the market, do expect the market overall to sell. And that's going to be, of course, one of the discussions here. Growth stocks typically fare best when economic growth is modest, what we call a deflationary boom. Now, if we're in a deflationary boom, expect 2024 to be pretty good for growth stocks. And again, value may be behind it. But for now, it's all been about rotation, and we will look at those soon. We can also see as well, coming out from Goldman Sachs here, that it looks like hedge funds, or at least US equity funds, were purchasing macro products pretty heavily over the last week, and they went back into buying the market after being net sellers notably for a little period of time there. So they were selling for a few weeks and then they've gone in hard. Are they having to hit this market to try to get some window dressing or something before the end of the year so they can say to their customers, hey, we made some money, don't worry, we didn't miss out on this rally? It's possible, and of course that could be one of the reasons we are rallying so hard, along with just the exceptional amount of calls that we've seen go into the markets. We'll talk about that soon. Small caps versus large caps. We mentioned this on December the 11th to February the 11th. We tend to see outperformance of small caps. In 2 days since then, we've done 6 to 7%. So we've almost done all of the 8% normal average in 2 days. Can it hold up though? Well, it is possible, because if you have a look at this read as well, with the massive amount of call options that have been coming out for the Russell 2000, it's really not necessarily a bad sign. I mean, in previous times when we've got these types of reads that are really high, markets have actually gone on rip runs for the Russell 2000. Something I'd keep in the back of my mind. We also do know that seasonality usually comes through here. Like we said, from December 11th to February the 11th, we tend to see the strongest run for the Russell 2000. And so far, it's smashed into 2 resistance points, including hitting one of the big take profit targets, being the 2000 number over the last 24 hours. Let's talk about Fed dot plots, because of course this is what everyone's discussing now. Now, what the Fed thinks and what's probably going to happen are going to be completely different. I would always say that these future positions based on interest rates have generally been wrong. You can pretty much prove that from 2022 to 23, the market's gone up, down, and all around, predicting 7 in total pivots and finally getting one right after 7 times. But yeah, this is what the current dot and pivot dot plot are saying. So the market basically says, hey, we're going to see a lot more cuts. And the Fed's saying, well, we think we're going to give you about 3. What about S&P 500 4-year cycling? Well, it does turn out that usually 2024, which is the election year, would have a positive correlation with it. But do remember that this comes in normal years. Now, we are most likely either going into a soft landing situation or the hard landing situation. And those will be decided generally around the first Fed cut. We also will see US 2-year at some point come underneath the US 10-year. So we will see uninversion of yield. That's actually when you should be most terrified of the market. And we've been very consistent by talking about that, because that's when we're going to see the real price action that will tell us whether we're getting the soft landing, which I actually would rather get because it's better than a hard landing really for everybody's families, or the hard landing, which is going to show some negative moves on the markets. That's going to be something that's interesting for 2024. And it's going to make markets, I think, quite volatile. And again, a pretty good trading year. Here are some of the laggards in terms of what's not been doing well up until recently. So you can really see that this is where the opportunity rises if we continue to see rotation through this market. And I'm not going to forget about the Grinch stat. I think this is a big one. 3 days before plus 3 days after Christmas. This is something that we will be tracking moving forward. So make sure to stay tuned for that one as well. This is what happens during options expiration week. 73.2% of the time we are bullish during the week. So far, that has been absolutely true. Of course, way higher than these percentages, and 75.6% the week after. So theoretically, this rally could run based on stats alone. Mag 7 as percentage of total US single stock net exposure. As we know, funds have been dumping the Mag 7 across the board as they've rotated into other sector markets. We saw this on the charts. We had a suspicion it was happening. And of course, we've so far been proven correct because the RSP is playing catch up. That's the equal weighted market. Another one for anybody that's looking at markets outside of the US, here's an interesting thing. Moody's downgraded, of course, China and Hong Kong recently. And when they've done that in the past, the results have not been necessarily negative the next year. In fact, they've all been positive. We've already read these out several times, so I'll leave it at that. Let's go through some big transactions. Now, we just got a monster transaction coming in from TLT. Not only was this previous support, but then we hit into it after a massive rally in yields. Now, I'm a big fan of treasuries moving forward into 2024. I did obviously think there could have been a little bit of a sell here based on the supply, but then Jerome Powell really didn't scare the market, which actually I thought he might have just said something slightly negative, but he basically didn't at all. He just let this market rally up. And then we hit into, of course, the number one trade. Could that be a sell? It's possible. But I still think treasuries, whatever pullbacks they do bring in, are most likely going to be met by bull demand. So pullback is possible for treasuries based on that huge sell at the key resistance. What about equal weighted market? Well, we just saw a massive dark pool transaction. Now, I'd have to say that's most likely some type of profit target. You can see a huge trade down here and a huge trade down here, some of the biggest in history. And those have, I would say, started to say, well, you know what, this was a pretty good run. We hit some take profit areas and maybe they have started to reduce in what is an epic rally. It doesn't mean it has to fall straight away though, but I want to talk options and unusual activity. Let me just go down here. I was preparing this before we were shooting the video and I was like, whoa, total trading options value, 60 million, normal 39, 60. That's a huge session. 64% calls as well. That's just massive. And it was one of the biggest trade sessions I've seen in quite some time. Retail, 26% of the single legs. And you can see here the unusual options volume was pretty much across the board. We had big moves on solar. That was one of the best sectors. First Solar coming through, one that a few members of our Market Masters Club was certainly heavy on. Obviously, we've been talking about Enphase here. And there were just so many really huge moves through some of these sectors. I mean, Enphase did 11.7 on a 1.9 times average volume. I also noticed Moderna came in hard at 9.2% this morning at 2.82% in terms of average 90-day volume. So there were some big trades. What was probably most interesting is we continued to be relatively flat in terms of Qs, and also the S&P 500 went super bullish. So look at this, super bullish, 6.13 versus 4.39. And take a look at the Russell, almost a 2-to-1 from the call to the put ratio. Some big deals there. Same type of thing happening also on Tesla, I noticed, and Tesla broke out of a coiled range. So could it be time for Tesla to actually start its little run here on the markets and start to play catch up? It seems likely because, of course, it's been doing nothing for some time. Effective yield dropping off, nothing to be concerned about if you are a bull in the markets. That's not really a bad sign. That's a good sign for you. And you can see here that equal weighted markets blew through these highs and continued to make on. Now, that's parabolic for sure, because you can see that these are very, very large, huge standard deviation candles. And this is not just a few up. This is quite a few up now. So we're clearly in a market that's in the twilight zone. That's fine if you're involved in it, and of course you can check it out and look. But the thing, even with the equal weight, now that it's gone like this, is you have to start breaking down sectors. We'll do it soon together. Let's have a look at the bond market. It is super hot. That's looking good. If you're a bull, US 2 versus 10, not even close to uninverting, so that's obviously not a concern. Consumer discretionary versus staples. The American consumer is hot on the markets right now. I mean, what can we say? The US 10-year is getting closer to some demand zones down here. So potentially after we fell through and we had that big move that we talked about, thanks Jerome, then of course we're now moving down to these areas. It's not really sitting in anything I would expect to spike the yields up heavily, but yeah, we'll see whether it can get down there. So again, that's not necessarily bad for bulls out there. And of course, treasuries smashing into what is a huge level, getting closer to the gap fill as well, which would be around $100. So yeah, big trade coming in, big rally. I mean, this is one of the most epic rallies, I guess, on treasuries for a long time. 20% very quickly, and huge volumes too. Look at the volumes across the board, just so massive down the bottom. And we've been discussing treasuries a lot. They are pinned to be one of the best investments of 24, but then everybody's talking about it now. It's not really a new thing. PCC dropped off here, so you can see that, of course, calls are starting to get loaded in the system super heavily. And look at home builders. I mean, yeah, it's not bearish, but geez, that's big. ITB, XHB, all of these things just flying, and they're pretty extreme. I mean, they're obviously in parabolic trends, and we'll talk more about that soon. What about central bankers? Well, central bankers were also injecting. I mean, it's It's like a clown show or something. Yeah, we've got central bankers pushing into the markets, going long. This is rallying the markets as well. People are now writing articles